The Chinese economy is being impacted by foreign outflows leaving the country and a weakening currency. However, as investors in Alibaba, should we be worried about this? That's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So you can see here that the Wall Street Journal reported that China's markets are being tested by foreign outflows and a falling currency. And what's interesting here is they say that while there are echoes of an earlier bout of stress, market participants say that this time it's different. And anytime someone says that this time it's different, those are generally dangerous words where they might actually conclude that things are worse than they actually are. However, in this article, you'll see that they actually concluded the other way, which also gives me pause. So, a withdrawal of foreign capital from China and a weaker yuan has prompted comparisons with 2015. And that's the time where Beijing faced a vicious cycle of outflows and currency depreciation. However, it looks like China has plugged many of those holes that once allowed its citizens and companies to move money out of the country. And I might add that one of the areas where the people would move their money into is real estate. Countries like Canada have really tightened up their grip on real estate investing by foreigners, and so it's harder to move your money into havens like Canada to stash it away from potential declines in the Chinese economy. And so you can see two areas where there's large sell-offs. So one is in the Chinese bond markets. April was the third straight month for substantial outflows. The second is that foreigners have also been pulling out of Chinese equity markets. And as Alibaba investors, ain't that the truth? And this graphic illustrates how much risk investors see in holding Chinese bonds. You can see here that you haven't seen this level of withdrawal in a long time. But one of the things that the article writers do state is that there are loopholes that were used historically that are now been closed. They go on to state that these loopholes have now been closed and outflows under the legitimate channels have been and likely will continue to be manageable. Now here's something I didn't know. The average individual person has an exchange quota of 50,000 US dollars per year. So you can only exchange out 50,000 US dollars of yuan. And it's not like the government doesn't understand that money is outflowing. They have implemented policies, or at least discussed policies, to help their economy. The first area is with the struggling internet sector. You can see here that the Chinese tech stocks actually surged a couple of weeks ago on a more supportive stance from China's leadership. But what I want to say here is that watch what they do, not what they say, but when they are speaking positively about their technology industry, that is something that sounds promising. So we'll wait and see what they do here. The second area of promise is that the central bank actually made an unexpected rate cut as the economy's growth has crumbled. And I believe that a rate cut will help their housing market and their business owners. However, the zero COVID policies are still a massive headwind for the economy, and there are no rate cuts and there's no flooding of cash into the economy that's going to save what negative impacts they're experiencing as a result of following these policies. And many market watchers argue that global investors are likely to remain long-term buyers of Chinese assets. And the reason for that is that Chinese securities help make portfolios more varied. And as Charlie Munger says, I can buy a lot more company over in China than I can in the US. And he's right. The valuations for these Chinese companies have gone to rock bottom levels. Like I've been saying on this channel for a while now, I actually believe that Alibaba is trading for under its liquidation value. However, a sharp recession in the US could bring the S&P down considerably and the valuation for US stocks down a ton, which makes them more competitive from a valuation perspective than Chinese stocks. And that actually might bring capital out of China and back into the US market more so than it already has. So that actually is not good news for Chinese stocks. However, at the end of the day, I don't really care who's buying and who's selling. All I care is what I'm getting for what I'm buying. And the writer of this article goes on to state something that I've been stating for a long time. In trying to generate robust growth while simultaneously pursuing a zero COVID approach, China's government is fighting a losing battle and something has to give. I call this the have your cake and eat it too. You can't do both. China is likely to end up expanding the money supply, which it has held relatively steady recently. Irrespective of what policy you follow, either way, you're gonna get currency depreciation. Now, I absolutely acknowledge that investing in companies that are listed in China is absolutely risky, especially in this environment, but there's another way to play global growth, and that is through strong American companies that are global growth focused. For example, you can see here, I've given you a picture of a new Crocs shoe with some decorations on it. The point I'm making is strong global American companies is a great way to globally diversify. And let's dive into it. So you can see here that the largest long-term growth opportunity for the Crocs network is China. China is the second largest footwear market in the world. And it's not like they're only focusing on China. They're also focusing on South Korea and India, and the outperformance in these areas continues. So effectively, a lot of you guys are strong international investors, and I'm trying to show you guys ways that you can invest in these international markets while purchasing depressed US securities as well. So it's just another way of diversifying your portfolio. And this is something that we talk about every month on our monthly calls with the Patreons. And you can see here the long-term guidance for Crocs. By 2026, they want the Crocs brand to hit $5 billion. And by 2024, they want their recent acquisition, Hey Dude, to achieve $1 billion. So effectively by 2026, they should have a little bit more than $6 billion in revenue. And that's really good because they finished 2021 at just over $2 billion in revenue. So they're expecting to grow revenue by 3 times in this short-term time period. And you can see here that of the companies that I'm following, Crocs is actually number 2 in terms of the share price as a percentage of its intrinsic value. Crocs is trading at what I believe is less than 40% of its intrinsic value. However, there are risks. You notice the company has debt, albeit my valuation is net of all of their debt, but they still have debt, which is a risk in a rising interest rate environment. The other area that they have a risk in is I don't believe that Crocs products are inflationary resistant. I believe that if a family is being pinched on their budget, new Crocs is something that they can go without. Finally, I don't think that they have a massive economic moat. I think that footwear is footwear and there's a lot of competition in the space. So effectively, you have a very undervalued security, but there are huge long-term risks. And what these long-term risks really do, especially the moat part, is it gives me a little bit of pause about the long-term economic viability of this brand. However, I think they'll probably do okay. Now, in terms of valuation, you can see here that at just a 15 times terminal multiple, I'm valuing the company at $180 per share. However, they did take on debt for the Hey Dude acquisition, and I've taken all of that debt out in terms of a negative excess cash. So I actually brought their valuation down considerably to $137 per share. But you can see that the market has really penalized them. They're valuing them at $54 a share, which is what reflects their 40% value as a percentage of intrinsic value. And you can see here that that $54 per share is effectively causing them to trade at 5 times earnings. And you can see from here, this is part of the model that you can click into when you have access to the Patreon. Management is guiding to $5 billion of Crocs sales and $1 billion of Hey Dude revenue, or I guess over $1 billion of Hey Dude revenue by 2026. And so my question is, can management hit guidance? And I believe that Asia growth will play a big part here. So if Asia does well, I think Crocs does well. However, if Asia enters into a turmoil, which it looks a little bit like it's happening, at least just in China, you could see management missing guidance here. Now, you also noted in my valuation model, I did bring their profitability down. I don't think they remain as profitable as they have in the last couple of years. The other thing is, though, Crocs has had a choppy past. So the other question I have is, what makes us so sure that the future is going to be better than their historical performance? So something to think about as we dive into this name. However, because the margin of safety is so large, and you can sell cash secured puts to get this around 2 or 3 times earnings, it becomes a very compelling opportunity. But like I always say, this isn't financial advice. I just try to give you guys my analysis. Always speak to your investment advisor before you make any acquisitions, just to make sure that these investments are right for you. And if you want access to the valuation model, you can get that at the $5 a month Patreon tier, and that gives you access to the tracker and all the individual models that accompany it. And because Patreon doesn't bill you until after the first month, you effectively get the first month free. And if you're not interested afterwards, by all means, please cancel. There's no risk to you. The other thing that I want you guys to be aware of is that we are now headed to what I believe is a recession, and that's really going to continue to take the stock market down further. So my question is, how do we get prepared? And so you can see that the next video that I'm going to be putting out is the 2022 recession game plan, how we should be prepared for what's coming. And so in order for you to not miss out on that video, please take 1 second right now and hit that subscribe button and ring that notification bell so that you don't miss that video when it comes out. I think it's one of the most important videos that I'm going to put out this year. Also, guys, Alibaba is going to report very soon, and I did a preview of their Q4 results, which you can get to right here.